All right, hey everybody. I'm Thomas Dunbar. I've got my partner Tony Brunini here with me as well. I'm about to flip into the PowerPoint mode, but really appreciate everyone giving us a few minutes here to learn more about insurance. So I will flip into the PowerPoint and maybe give it one more minute, and then I'll get started. Uh, let's see here. All right, can someone with their video camera on nod if you can see my PowerPoint here? All right, great. All right, well, we'll go ahead and dive into this. We don't want to we want to respect everybody's time. So I'm Thomas Dunbar. I've got my partner Tony Bernini here as well. I know we've worked with some of the people on the call before, but not everyone. Tony spent the first 15 years of his career as an actual affordable housing developer, syndicator, and lender. I was a CPA until 2020, and for the last 6 years, all we've done is provide insurance products to affordable housing owners, operators, and developers from coast to coast. Uh, Tony's the wise old owl. I'm the young grasshopper, and this is all we do. We'll dive in here just with uh, construction phase insurance. The goal today really is to twofold. The first part here is we want to just lay out what policies do you actually need as the developer from construction through post construction through the perm phase. And then secondly, after we go over the policies, we want to talk about what actually moves the needle and drives the premium on those policies. What can we do to protect our developments, but keep insurance costs to a minimum while fulfilling our syndicator and lender requirements. So for any construction phase, for the construction phase of any project, you're going to have a few policies that are required for the ownership entity to carry. The first is your builder's risk. The second is your partnership liability, also known as your ownership liability. And then the third policy is an excess liability policy that simply extends over the general liability policy. We'll get into it later, but your builder's risk covers property events like stolen equipment and fires, tornadoes, and then your liability would cover slip and falls and assault and batteries, liability claims against the ownership entity. And then for any closing, uh, a lot of the syndication and lending community, they want to see a post-construction, annual perm insurance estimate at closing. We can't, it's no insurance carrier will offer us a live quote at construction closing to be effective, a year or 2 years into the future during the perm phase, but we can, or you can get a perm insurance, back in the napkin estimate to so the lender, so your deal team is satisfied. So those are the three policies that are the three items that you need at closing. And please, anybody, stop me at any time if you have any questions. I'm happy to answer questions as they come to your mind, or we can take questions at the end. But if we'll move on to the next slide here and get into actual, what is builder's risk and what drives it. So the main cost factors that go into what dictates they go into your insurance premium for a builder's risk policy is the first item is your project location. Where is the site? Uh, Certain locations are definitely better than others. The Gulf South, the out west, the Midwest, those are all tougher areas that dictate higher insurance premiums. Uh, so that your location is the first variable any underwriter is going to look at. Secondly, they'll look at the size of your project. Is this a $5 million contract with your GC, or is it a $35 million contract with your GC? And we'll get into it later, but as that number goes up, as your project gets bigger, there are fewer and fewer insurance carriers willing to entertain quoting your project. So that's point number two. Number three is your construction, your Gantt chart, or your construction timeline. How long is this project actually going to last? That's a direct factor into your builder's risk premium. Next, it's does your GC have experience and a track record that the underwriters like and they want to see. They want to see a great looking website that shows a lot of previous multifamily housing experience with any GC. Next, what are your job site security measures? Is your project going to be fenced? Is it going to be well lit? Are you going to have video surveillance? Are you going to have a off duty or a security guard or a night watchman? Those are definitely questions the underwriters are going to ask. Next, what is your building actually going to be constructed of? 90% of the projects we insure are wood frame construction, which is I guess, the least desired construction class. But if you can get they'll look to see if the project will be masonry or non-combustible or a joisted masonry. And then last, if you're doing an ACK rehab project, the carriers are going to look at what the value of the existing structure is. You're going to have a builder's risk to cover the rehab work going into the project, and then you're also going to need a existing structure policy to cover the pre-existing structure. And the higher that replacement cost valuation is, the higher your premium is going to be. Penny, would you add anything to any of those cost factors, or would you any points that you want to commentate further on?
I think when Thomas mentioned, the project location, we know that frame deals in Oklahoma are definitely going to be more expensive than frame deals in Pennsylvania, just from a convective wind exposure, or say California from a wildfire exposure, and you throw in obviously the coastal areas, there's going to be a named storm exposure. So that's why those costs would be a little bit different based on your project location.
Yeah, and another point we want to emphasize here is we really try to recommend that the development ownership entity carries the builder's risk as opposed to the general contractor. We have a few points to the right on this slide here, kind of explaining why we think it's better for the developer, not the general contractor, to carry the builder's risk. And the number one reason is it just makes your transition to permanent insurance, permanent property coverage after the project much easier if you carry the builder's risk and you have what's called a permission to occupy provision on the builder's risk policy. That will give you the flexibility that is really helpful, especially if you have a multi-building project, when you're getting COs for each building at different times. It can really make a big difference, being able to keep that project on the builder's risk policy for as long as possible, rather than running into a problem because you don't have permission to occupy on your builder's risk policy. I think we may have some background noise. You think we could all mute? Is there somebody? See, there may be somebody with a background. Let's see if I can mute everybody here.
And the deposit has really
Let's
reduced that
see.
US Bank, which is receiving a larger and larger gap. It's going to have to be filled from someplace, but we don't know.
While Thomas works on that, I will mention that on an ACK rehab project, we've been really successful the last couple of years creating hybrid programs that cover existing structure and builder's risk on one policy. And that would be provided by the ownership group, and it streamlines any type of potential claims issue, which we really like. We think that that's a great idea, to have one carrier as opposed to multiple carriers. And that's something that the general contractor couldn't provide because he wouldn't have any interest in existing structure coverage.
All right. Well, I think we're good to go here. All right. Can everybody hear me? Even though I just muted everyone, that's funny. Let's see.
I have a
Hey.
question for you
Hey, Letty,
guys.
yeah, fire away.
Can you hear me?
Yeah.
Yes.
Hi, this is Letty Valencia, affordable housing developer in Chicago. What do you guys think the underwriters use to, kind of project what a crime or a bad neighborhood is? Because I ran into this issue as we were developing the project, that our investor came out with these like crazy crime. I don't know where they got them from.
This
But
statistics.
this specific area is like extremely safe, right in the middle of the village, in front of the police department, the fire department. It's a very, tight-knit community, so, the statistics out there may not reflect what's happening in the neighborhood.
I think what you will see is most of our lender and syndicator insurance requirements, or excuse me, most of our carrier insurance requirements are going to be based on a statistics derived from a zip code. It won't be necessarily for your project, and that's where the important part comes in to give the narrative of why you're a little bit different than everybody else typically in that zip code. If you're across the street from a police station, the narrative that you can build to present to an insurance carrier why your project should be rated a little bit differently. Every builder's risk carrier today is going to require some sort of security protocol, whether that's fenced and lighting at a minimum of a site. They're going to want to see their biggest exposure is a vandalism fire claim, right? That would potentially disrupt that building envelope, and so they want to eliminate as many exposures to that as they can. And if you do have a unique site that is more insulated than the generic zip code around that is great information that your agent needs to have to present that to the carrier to say, hey, not only are we going to do, we're going to isolate this project by fences and we'll have full lighting up at night, but we are directly across the street from a police station, and that would add a little bit of color to that discussion and maybe get you a little bit better rate or more friendlier terms where, okay, maybe not a night watchman isn't necessary for the project to length. Sometimes we get them, if it's a new construction project, we can work on staggering those insurance requirements to come into play once you hit a vertical construction, because there might not be a big need to have a fence site until after that site work is finished, and then you would put the fence site, or you wouldn't put a night watchman on or a camera in place until you're going vertical. So there are ways to limit some of those requirements that you're going to be forced with. But I can tell you this much: the market has shifted dramatically from where we were about 5 years ago. There was nothing required other than maybe a fence and lights. And today, most projects, that's a minimum. And the larger the value of the project, the more insurance requirements you're going to have. And they are going to increase those requirements if you are in a crime score area that is elevated or higher than the national average. And so aerial maps showing your location in the vicinity of what else is around that can be helpful. If you're next to, a lot of vacant property, that's going to be problematic. But if you're next to a police station, that's going to be an asset. So I think it's about building that narrative, and there's more to the project than just that construction budget. This is the information that you guys hold that makes our job a lot easier when we can get that dialogue going with you on how to best present a risk.
Okay, well, that's helpful for future projects.
Yes.
I know I'm working on a perm property with you guys. I wanted to mention think we have a lot of contingency left, so we do want to add cameras
Oh, good.
to the development there. So that should bring our costs down.
Well, I can tell you this. What it does is it's the most effective dollars you can spend on security. I think the camera
Okay.
side of it is dollars that are much more user friendly than, say, trying to put on a physical surveillance of the property or have a security personnel. A camera is a much more effective tool for us. It is an asset. I can't necessarily say that it drives rates down, but like you said, it builds a narrative of why, hey, this is our property. This is what we've done in this neighborhood, and this is how we think we've got it better than the average properties around us, and why we should be given better consideration for rate. And that may be not just liability rate; it'll also be property rates. Cameras are a great tool, and I think the most cost-effective tool you could use from a security standpoint.
Okay, and going back to your previous slide, we typically don't purchase the property before we close on a deal, but We did do it on our next deal. And I was under the assumption like if it's a vacant lot, you wouldn't necessarily
But
need land insurance.
what
Can
we
you
typically
talk a
put in
little bit
place,
more about what land needs to be
typically what
insured?
you put in place is a vacant land GL policy, and that helps protect the ownership entity in case someone is on that site and a trespasser and hurts themselves and somehow sues. That vacant land policy, you can bind them for 6 months or even a year. They're based on acreage, not square feet. It's a very low rate. Usually
Yeah.
those policies are, $1,000 or less. So in the big scheme of a project, that's an easy fix that we
Okay.
can put into place, and it doesn't cost, in the big scheme of things, it's just almost not a factor at all. But it satisfies their lender requirement for taking down that land before you close your deal or
Okay.
before construction starts. Very common
Okay.
practice.
And then on extending your builder's risk, how can we help make that process less painful?
That's a good question. I would encourage everybody here to have their agent involved in getting a pay application from the contractor, at least when you hit 50% construction completion. That's a good idea to bring in your agent to where at least they're copied on that pay application so they can track the progress of that project, look at our X date, and then work backwards and say, okay, well, maybe we're going to have a problem here. I see that we're 50% through, but we only have 2 months left in our project schedule, or excuse me, our insurance program. So we know ahead of time that we're going to have to extend that policy. And that would help us go ahead and build it because it's about a narrative. Every builder's risk carrier wants to know why you have to extend that policy. You gave me a construction budget on the front end that included a Gantt chart. So what's changed? And being able to identify, it was, we ran into a problem, be able to get permits or whatnot, whatever it is, that narrative goes a long way into getting that extension. But they're going to ask pretty specific questions. Most of them can be answered by that pay application, and then there'll be a little bit of narrative that can be provided context on. Just give me a little bit of reason. Was it a labor shortage? Was it a material shortage? What is caused that? It could be a utility service connection that was delayed. There are thousands of different reasons why, but getting ahead of that is probably the best thing that you can do, and your agent can do to help prevent it being harder than it should be.
Okay. And we're starting a new project. How soon should I engage you guys on a builder's risk?
Let's say 60 to 90 days before you need that policy to be in effect would be my gut answer. A couple months would be helpful.
Okay.
Yeah. Cool. And I think we had one other question on, why the developer, not the GC, should carry the builder's risk policy. I think someone had that in the chat. So these are the 4 reasons why, over here on the right part of this slide. The main reason, when the developer carries the builder's risk, not the GC, it creates a smoother transition to permanent insurance because your policy will have a permission to occupy provision in it, while the general contractor's policy likely will not. And you want to be able to keep that project on the builder's risk, or have the option to keep it on the builder's risk for as long as possible, because some of the best insurance carriers for perm insurance, they require all of your buildings in the development to have their COs, certificates of occupancy, before they'll insure the development. So you don't want to run into a situation where some buildings have COs, some do not, but you can't begin lease up on your project because you're still on your builder's risk, and your builder's risk does not allow permission to occupy. So that's what you want to avoid. And then the next point is your syndicators and lenders will typically require a standalone or non-reporting form builder's risk policy, which many general contractors don't carry. General contractors usually carry your master builder's risk policy, and at the end of every month, they report their construction work under the policy to the carrier, and then that policy covers all of their projects, not just the one project that you're involved with. And our, the syndicators and lenders are worried that a problem on that GC's builder's risk policy relating to a different project could lead to a cancellation on your project. So your deal team's usually going to want your project to have a standalone non-reporting form builder's risk policy. Next, if there's a claim, you want to be involved in the middle of that claim disbursement process. You want to be in control, not the GC. And then lastly, if you buy the builder's risk policy, not the GC, you don't have to worry about any general contractor, administrative fee markups on their policy, which we see oftentimes the general contractors will put 5 to 15%, administrative fee on their builder's risk, which if you buy the builder's risk policy, you don't have to worry about that. So those are the main reasons why we would suggest the developer carry the builder's risk, not the general contractor. Tony, would you add anything there?
That's good.
All right, I'm going to move on just in the interest of time to our next slide here. We're going to talk about construction phase liability. This is what ensures your ownership entity during construction. The main cost factors are the project location. Where is this project being built? Is it in a high crime area or a low crime area? What is your insurance and risk transfer provisions in your owner GC construction contract? What do they look like? What's your construction contract value? Does your general contractor have experience building multifamily? What your job site safety practices and procedures are, and then what are your building materials? This is a policy that every syndicator and lender requires you to carry, but fortunately, on 99% of the projects that we insure, that we see, the general contractor will take on most of the responsibility for any construction related liability claim. The general contractor's liability policy is supposed to fall in place first, and your ownership entity liability policy should really serve as a backup option or a fallback option. Your ownership liability policy should never be first in line, and your ownership entity should be listed as an additional insured on your general contractor's liability policy, so your entity is covered under their policy. Potential claims here are somebody runs on the job site, falls in a hole, or gets hurt on the job site. There could be an assault and battery event on the site that you get brought into a lawsuit on account of, and then any other potential property damage or physical injury to a third party that could be somehow tied back to your ownership entity negligence. That's what this policy is supposed to ensure.
And it's rated on contract value, hard cost of that contract. So that's how their rating mechanism, and it's pretty standard across all 50 states, with the exception being maybe New York, being a little bit of an outlier from a price perspective.
And the one back of the napkin way to budget for this is if you have a $10 million construction contract with your GC, your ownership liability, this policy should cost around $10,000 for a $10 million ownership contract with your GC. That's just a quick way to budget for this. We see about a 1,000 for a million ratio there. Let's see here. Michelle McGuire has a question on thoughts on a wrap up, either owner controlled or contractor controlled wrap ups.
So where we're seeing the win on that, Michelle, is that typically the larger the project, it's a way for us to, and we certainly advise the owner control program. It's a way for us to bring cost efficiency to the project. You can get that OI policy basically embedded into that wrap policy, and it doesn't cost you near as much as the two animals independently. The GC's insurance, sometimes we see their liability insurance as a budgeted number in the construction budget. So we kind of know, all right, if this is a $25 to $50 million project, and we see a budget from the GC that has a liability number that's fairly high, we can say, okay, well, here's an opportunity for us to bring the cost of that program down, plus include the cost of the owner's interest policy at a much lower rate. So we've really had a lot of success doing these on projects. I would say at a minimum of a $25 million construction contract. That's where we start to see, every bit larger than that, it really makes sense. Some GCs are a little bit reluctant, but we love that process because we think it's independent to that one project. And so you don't have to be worried about any other projects that the GC is involved in and coverage that he might have canceled. It's a safe and secure way and a cost effective way to ensure the GC and the owner for that specific project. We've had great success with this product. It does not make sense though when you get below, I would say $20 million for sure. The numbers don't add up.
Is this different than a placed in service certificate liability?
This is an owner's contractor's insurance program that combines that during the construction phase. So it takes two independent, it takes the two parties involved in the project and puts them into one liability policy for the term of that construction contract or the term of that project. So it's all during construction phase insurance.
Okay.
All right, well, if there aren't any other questions, we'll move on to the next slide here. So we hear a lot of, we know there's a lot of pain and angst in the industry, getting your insurance signed off on leading up to a closing. It seems this has become a lot more difficult than it needs to be. So on this slide, we've laid out, in our experience or from our perspective, what's the best way to approach getting your lender and syndicator signed off on your insurance certificates leading up to a new construction or an ac rehab or just an acquisition closing. And the main theme here would be just to get your agent involved in the process as soon as possible and get him plugged in with your lender and syndicator insurance review team earlier as opposed to later. So on our team, what we like to do, about 120 days out from closing, that's when we're starting to provide estimates for your budgeting purposes for the construction phase insurance as well as your perm phase insurance. Between 90 and 120 days before closing, we want to start looking at your syndicator and lender insurance requirements to see if there are any requirements that are potentially going to be a problem or overburdensome or inefficient. It's nice to be able to go out, actually start working with insurance carriers, go out to market between 60 and 90 days before the target closing date. After we get quotes back from the carriers, we can send out draft insurance certificates to the lenders and syndicators for their review. And it's helpful if we can do that, 30 to 60 days before closing. So everyone has plenty of time to, review what you're planning to have in effect during the construction phase insurance wise and address any problems, 60 to 30 days before closing. So, usually around 30 to 15 days before closing, it's helpful if your agent can have all the lender and syndicator feedback and their requested changes to the draft certificates, around 14 to, really 14 days before closing. That's helpful because your agent needs to be able to go back to the carriers and make those changes and get a revised quote and then deal with any problems on the quote. And then, once those draft certificates are fully signed off on and finalized, around 5 to 7 days before closing, you want to bind your insurance effective as of the target closing date. You want to do that 5 to 7 days before the closing date, though, because that gives the carriers a few days to issue policy numbers and effective dates and issue the policies to your agent to then be able to circulate final insurance certificates before the closing. So you're not, nobody's waiting on insurance for closing to be able to take place. And then you want to make sure you get an invoice from your agent to submit to the closing draw so your construction phase insurance premiums can be paid from that closing draw at closing. This is, Tony's been doing this for 15 years, and this is what we found is at the end of the day is the best process leading up to a closing. Tony, would you add anything here?
I just can't stress how important it is that the faster we get to the lenders and syndicators to adjust to get their comments back, the faster we know about any potential problems. And some of that is It's, it could be on an act rehab where there is a difference of opinion on insurable value of the existing structure. It could be things like that there does need to be a conversation. And so getting those comments back quickly can help have that conversation. You can get past that problem, well in advance of closing.
We found it's also helpful too if we can get in touch with your lenders and investors directly to be able to correspond with them directly and keep the development team CC'd, obviously. But we don't want if we can get in touch with your syndicators and lenders directly, we can address their comments directly. And we avoid the telephone game of your lenders and syndicators sending the developer comments, and then those comments have to get relayed back to us. And just being able to take one step out of that process, it can really save a ton of time and make life easier for all parties. Are there any questions on this insurance review and closing timeline? Tim, thank you for the feedback here. Any questions on these steps? All right. Well, if not, we'll move into post-construction or perm insurance. It's very similar to your construction phase insurance, with the exception of, instead of a builder's risk policy to cover the building as it's constructed, you're going to have a property insurance policy to insure the building, post construction. So there's three policies you need to be aware of. The first is your property policy that covers, fire and tornado, wind and hail damage, property claims. Next is your general liability, and then lastly you have your excess liability policy. So then your excess liability just extends over your general liability, and it's just three policies. That's all that your ownership entity will need to carry, for one specific development. And then we have a note here that your certificates of occupancy are usually required before your carriers will let you bind permanent insurance policies. So that goes back to the point about on your builder's risk. It's helpful if you can start leasing up your buildings while the buildings are still on your builder's risk policy. We'll get into a kind of a deeper dive on property insurance here. The number one question we get when we make a property insurance submission is, when was the building originally constructed? The long story short is the carriers, they want to insure newer buildings and they are fearful of insuring older buildings. So, how old is the building? That's the first question. Next, where's the location? What's the building composed of? What are the building materials? What's your building's replacement cost value? If the building was burned down today, how much would it cost to rebuild that building? That's what the carriers are concerned about. They're not as much worried about how much the building would sell for in a sales transaction. They are concerned though about how much that building would cost to rebuild. Next, what's your building square footage and that replacement cost per square foot? And then finally, what are your loss prevention and security features? Are you sprinklered? Do you have smoke detectors? Do you have carbon monoxide detectors? Do you have a security guard? Do you have a property manager on site? Those are all the loss prevention and security features questions. Common claims: theft, wind and hail, kitchen fires, tornadoes, hurricanes, vandalism. Common, just like your homeowner's insurance. Common property claims. And then lastly, we have a note here that flood and earthquake coverage are typically not included on a standard property insurance policy. You have to either add those coverages back on or buy flood and earthquake coverage separately. So just because you have a property insurance policy, don't assume that flood or earthquake claims would automatically be covered under your property insurance policy unless you've added it back on or bought a separate policy. Tony, would you add anything there?
I think the property replacement cost value, that's the number one kind of issue we're having right now, is making sure we're adequately but not over insuring these properties. We know that construction values have increased dramatically over the last 5 years, and so the RCVs are going up across the board. I was at a conference and Thomas and I were in Georgia this past week, and we were talking about cost to build in California versus in Georgia, and they're $1 million a unit in California, where it may be $140,000 a unit in Georgia. So everything's relative to your area, but that is the number one driver of questions that we have today, and how to best, your goal is to hit that conservatively, not spending dollars on insurance values that you're not going to be able to recoup. You don't want to be overinsured. And we know that our lenders and syndicators are your partners and they have a very large voice in this, but they want zero risk. And there's usually some reasonable negotiation there on setting values that everybody can live with.
Tom, can I have a question?
Sure.
So you on this slide here, you talk about loss prevention and security features, and I was thinking about just different design elements that we can ask our architects to include in a project. Is there, from an insurance standpoint, are there different things that we can make sure that are included in a project that when we're being underwritten for perm insurance, that we should be making sure that our architect is including in the design?
I think that the biggest issue we see and the one opportunity for real strives that I have not yet been able to convince the GC side of the deal is to have a sprinkler system that encompasses the attic space or not just the livable space. So traditionally our multifamily builds are all using a life safety sprinkler system. Anything over 2 stories is going to probably have a sprinkler system requirement across most of the country, at least from 3 stories and up. And 99% of the time we see life safety fire suppression systems only. If you can include a more robust fire protection sprinkler system, that immediately drives down the rate. And it's probably the single biggest factor that you can bring to a program, to a property that you could do. Now, on the front end, there's a cost side of that, right? There's a reason why that R13 system is so popular, because it's less sprinkler heads, it's less pipe, it's less mechanical for them to encompass into the construction budget. And so therefore we don't see it very often. But I think to me that's the biggest obstacle from driving rates down lower is having that R13 system. And I know that's more related to just the property. Traditionally, all of these are the life safety feature, to where they're built to get a tenant out of the unit and control that fire from harming an individual, but it doesn't control the fire from spreading to another unit. And so to me, that's the biggest difference I think we can make. Overall design of the building itself may work from a liability perspective. Having ingress and egress access to a minimum locations is always good from a security protocol. It also eliminates, you can focus your video surveillance onto targeted areas that are driving all of your traffic that we love to see. Thomas, you got anything that jumps off the top of your head?
Yeah, I think we'll get into it later, Tim, but just the creating designing a development that underwriters want to insure, not too big, not too small. That we'll get into it later, but sometimes when you have too much insurable value in one location, it eliminates a lot of carriers from quoting. And then if you have too many roofs in one location, it eliminates carriers from quoting. So having, what we're seeing right now gets the best insurance pricing is a 3-story building that's between 12 and 40 units. That's the best. That's what we see gets the best insurance pricing versus a single family home rental style or a larger development. We'll get into it later, but designing the right, getting the right insurable value in the right location with the right distance between buildings. That would be my off the cuff response. Any other questions on property insurance? All right. Well, if not, we'll get into, kind of a perm property insurance checklist. So you get a property insurance quote. Here are the 5 or 6 items that we would recommend looking at first, or, asking your agent to tell you about. The first is, is your deductible on a dollar basis or is it on a percentage basis? Sometimes you may have a $10,000 deductible, or you may have what's called a percentage deductible. Your quote will say you have a 1%, a 2%, 3%, 4%, or 5% deductible. And that percentage is not the deductible, not the amount that you'll be on the hook for. That's that percentage is the percentage of your building value that's your deductible, not the amount of the claim. So if you have $1 million building, a 1% deductible is a $10,000 deductible. It's not, it has nothing to do with you having a $10,000 claim and then having a $100 deductible, 1% of that $10,000 claim. It's a percentage deductible of the building value, not the claim amount. And then, next is your deductible on a per building basis, or is it on a per location basis? You at some developments, you may have 5 buildings at one site. And does that deductible apply per building, or does it apply, for all 5 buildings combined? That's the next question. Next is, what's your replacement cost valuation per square foot? Or and it doesn't look reasonable to you. If your building burned down today, could you rebuild your building for that valuation? Next, what's your policy term? Most property policies we see are 12 months long, but your premium will double based on a 6-month policy versus a 12-month policy. So checking that policy term is important. Your building valuation, making sure the quote is on a replacement cost basis. That's what your lenders and syndicators will require, replacement cost. So there's making sure your quote has a replacement cost valuation. That's important. And then lastly, if you're insuring a rehab project that includes, an existing structure plus a builder's risk policy ensuring the rehab work going into the building, is that existing structure and the rehab work, are they covered by the same carrier or covered by different carriers? It's not always possible, but it's the most beneficial for you if you can put both the existing structure and the rehab work. If you can have both sides insured by the same carrier, that makes life a lot easier in the event of a claim. It's not always possible depending on the location and the size of the project. But if it is possible, we always would recommend insuring the existing structure and the rehab work with the same carrier, just because you don't want a fight in the event of a claim on what's covered under what policy. Tony, would you you have a different checklist, or would you add anything here? Any questions on this checklist? All right. Well, next we'll get into perm liability insurance. This is pretty straightforward. So your perm liability policy is going to be rated on your development's unit count. So a 100-unit building is going to have it's going to be rated off of 100 units. That's just something to keep in mind. Where's the project located? Is it in a high crime area or a low crime area? What kind of on-site amenities are on site? You have a swimming pool, playground, tennis court, exercise room. That each one of those will increase your liability premium slightly. And then lastly, building security features. Do you have security guard? Is the security guard armed or unarmed? Do you have fencing, controlled access, lighting, emergency pool cores? We'll get into that later. And then your common liability claims, or the 3 types of liability claims that we see, which are probably 99% of all claims that we see, are most commonly slip and falls. Next are assault and battery claims. And then lastly, sexual abuse and molestation. So we'll get into on this next slide, really the 3 things you want to worry about if you have once you see your perm liability quote is, do you have an assault and battery coverage exclusion or a sublimit? Do you have an abuse and molestation coverage exclusion or sublimit? And then is this quote rated on an accurate apartment unit count? If you have a 100-unit development, somewhere on that quote, it should say this quote is rated off of 100 apartment units. So those are the three items on the checklist to keep in mind. We've got a question here from Logan. It says, how are replacement costs typically determined? Is there an industry standard minimum? How often do you see a minimum TIV requirement lender equal to or greater than loan amount? I would say or Johnny, you want to take I would say it starts off by your location. And in the big metro areas, we see higher replacement cost values versus more rural areas. They tend to go down. We can run a Marshall Swift valuation, which is an internal valuation that we can run to give us some idea of what the average cost is in that area. And then lastly, if it's a new construction deal, you can look at your pay app and then try to back out site work and foundation costs and anything that would not be repeatable in the event of a claim. But your construction pay app on a new construction project would give you some idea of what it would cost to rebuild in the event of a total loss.
Just like I was talking about earlier, I mentioned when Thomas and I were in Georgia at the conference, we had a discussion about California the cost of a unit in California being $1 million. So replacement cost value is could be very different depending on your location. Here in Mississippi, we can get by with maybe $125,000 a unit on a typical frame, garden style apartment complex. That would certainly be in line with what we see. But if you're in California, it could be $1 million. The bigger comment here is to make sure that someone is looking at that, running a Marshall Swift valuation, or you have a pay application to go off of, because like I said earlier, our lender syndicator partners' traditional reaction is to they want to be extra conservative. They don't want to take any risk, so they want to see as high replacement cost value as they think they're comfortable with, but that may not necessarily, it may be overinsured, and that doesn't do you any good. So there's a balancing act there. And that Marshall Swift gives us the industry averages for that location and the type of build it is, if it's frame or if it's masonry non-combustible. We see a lot of appraisals that are being used from a lender syndicator perspective to justify replacement cost values. And frankly, we like to have those appraisals as just another piece of information source that we use, but we're much more dialed into a Marshall Swift because there's a lot of information in the appraisal that may not be accurate. It could have the square footage actually wrong. We would pull building plans and look at square footage there and input those into Marshall Swift. So I think having an independent valuation done helps justify maybe a lower insurance replacement cost value that you're comfortable with, but you're going to have to take that step to make your lender syndicator comfortable with them.
Right.
Well, one of the things we're seeing, we'll talk about that perm liability insurance. Fannie Mae and Freddie Mac are probably the biggest obstacles right now in the liability marketplace. They have requirements that are a little bit onerous and that are hard to sometimes meet because they have no exclusion for assault and battery, abuse and molestation, a canine requirement in there. And so all of these coverages may not be available at every site across the country. And so there are times that your location drives an outside influence on what coverage you're going to be able to get. So just be cognizant of that. Right now, Fannie and Freddie deals have the most onerous insurance requirements that we see on the perm side.
All right, looks like no further questions there. So now we'll get into some just general rules of thumb, pre-acquisition and pre-development, just to keep in mind as you're designing and thinking about deals to keep your insurance costs down. So tip number one here is, I mentioned it earlier, but the younger your building is, the newer the building is, the lower your perm insurance costs are going to be as a rule of thumb. Every year, your underwriters on January 1st of every year, they're given insurance quote guidelines by their higher ups, and those guidelines say you can't offer a quote for any building constructed before a certain date. So that's commonly the year 2000, 1990, 1980. There's very few carriers who are willing to insure buildings originally constructed before 1975 on a standalone basis. So it's helpful to keep in mind that the older the building, the more of an insurance uphill battle you're going to have when it comes to getting cost efficient insurance pricing. Next, we'll get into
Sorry, Tim. Does that include if you do a substantial rehab of a building?
It does. We can't take away the original date of construction. That's always going to follow the project. And even though it's gone through, that's great. You want to have that. It's better having a substantially rehabilitated project than one that was all original. They do like to see electrical and plumbing have been updated. So those are benefits to a rehab project. End of the day, they're going to be carriers that simply have a line in the sand that say, if it's pre-1980, we won't write it. Right. Some of that has to do with building codes. Some of that has to do with just the potential for older appliances. Older infrastructure in place that hasn't been renovated. So it's There's markets specifically for, say, a historic product. So there's another end of the spectrum. If you have a historic renovation, that project is on the historic registry. There are specific markets that provide coverage for those products that are competitive, and they give you some additional benefits in those coverage. I've got one that we were renewing right now. I think it's an 11-story tower in Great Bend, Kansas, which is the tallest by hundreds of miles. It looks like the Eiffel Tower, but it's on the historic registry, and there's a specific property policy that's in play for that animal, and it's cost effective. It provides more coverage than you would traditionally get out of just an older property that wasn't on a historic registry. So there are some caveats to that where you do see these really unique carriers that like an older building, but they have to be specific to the historic registry and then still fit inside their little small world of this is what we really like.
All right. Well, next we'll get into tip number 2 here, which is your property insurance premium. Generally, I would say off the cuff, your property premium will be between 60 and 80% of your development's total insurance premium. You know, the liability insurance will be between 40 and 20% of the premium, of the total premium. And the property insurers, they price the risk based on the square footage of the building and the construction replacement cost value, not your unit count or your tenant count. So a 100-unit building that's 100,000 square feet on a per unit basis will have much better insurance pricing than a 50-unit building with that same footprint, because your property carriers, they don't care about the number of units in the building. They care about how many square feet is how big is the building, and then what's the cost to rebuild. So where we see the best insurance pricing on a per unit basis is when you have less than 1,000 building square feet per unit. So generally rule of thumb here is the fewer square feet per unit, the lower your per unit insurance costs will typically be, because your property insurers and property carriers, which, you know, your property insurance is 60 to 80% of your total cost of insurance. They don't care about your number of units. They just care about the total building size and the cost to rebuild that building, not your unit count. So a 100-unit building with 100,000 square feet is going to get better per unit insurance price than the same building with only 50 units in that same footprint. Any questions here? We get a lot of questions about, you know, we totally understand everyone wants to talk, you know, per unit pricing. It's just, I think it's helpful to understand that, you know, a lot of your premiums not driven by your unit count, it's driven by the building size. Did someone have a question? All right, well, we'll get into tip number 3, which is, you know, insurance companies are scared of high building replacement cost concentrations in a single location. If you, the more value in one location, the fewer the carriers who will be available or willing to quote. But if you can put 75 feet or more between buildings, we can generally classify each of those 2 buildings as 2 different locations. And so it splits the value and then, you know, lowers the value in each location. So Tim, maybe this might go back to your previous question, but if you can get 75 feet between buildings, that's generally really helpful, because the underwriters view those buildings as two separate locations, and they can, you know, you're more likely to fit in their box because you're going to have less value per location versus having a high concentration of value in one location. Any questions here? All right, next, you know, every insurance carrier is going to look at your zip code's crime score as part of their underwriting for a building in that zip code. The higher your crime scores, or the worse the crime score, the higher your insurance premiums will typically be. You can go to this website, bestplaces.net, and that website will tell you or give you a good idea of what every zip code's crime score is. So this website could be a good one to save to your computer to check when you're looking at deals.
And there are carriers out there today that use that as a strict guideline. Will they offer liability coverage along with property coverage? If it's a standard market carrier that covers both, they'll look at that crime score, and it may dictate, or it will dictate, if they can offer coverages like liability in a package program. So it's important to kind of understand what your market is, what's it going to look like. And if the higher the crime score, the less carriers that are going to be, or the more security, the higher the deductible, there are going to be requirements that are placed on it based on the crime score. It's a fact of life that every carrier from builder's risk to liability are using in their underwriting process.
All right, well, next we'll go to tip number 5 here. And this essentially says the higher your building's occupancy level, the lower your insurance costs will be. Many carriers are scared of buildings with low occupancy rates. They want to see a occupied operational building. And if your building occupancy rate falls beneath 70%, sometimes your policy can be totally void, or it can totally, your coverage can be super restricted, or, carved back if you fall below a certain occupancy threshold. So the rule of thumb here is the higher your occupancy rate, the better your insurance will be, and vice versa on the lower the occupancy rate. I think we may have a question here. Let's see. Michelle, thank you. And then Chris Wittenhall says, if a building is beyond 75 feet, I guess distance between buildings, such as 100 to 150 feet, is that even more beneficial? I would say, yeah, the more the better. But
I don't think there's an advantage for being over 100 to 150. If you're at 100 feet, that is probably going to be everybody's best number. It wouldn't be an advantage to be 125 feet. If you're 100 feet, then you've hit it on the nail. Then every carrier is going to look at that as like, all right, that satisfies me completely. I can rate this separate building as, a different location. And so 100 feet I don't see any reason to be 125 feet, but if you can get 100, and we know that in a perfect world, we would design these from an insurance perspective, but that may not be the best marketing, or you're restricted from a general land use opportunity, or traditional guidelines in the QAP for what type of structures you need to have.
All right, we'll get into tip number 6 here, which is another question. Let's see. Thanks. All right. Okay, yeah. During acquisition due diligence, it's helpful if you can request the seller, the current building owner, the seller's insurance policy as early on in the acquisition due diligence process as possible to get some insight into their current premiums, their current coverages, current limits, and current exclusions. And also, if you can request their 5-year loss runs, which would show the last 5 years of loss history for that building, that will be very helpful. Both those 2 documents will be very helpful for you when it comes to you trying to put insurance in place, for the acquisition. If a building is insured by the seller on a master portfolio program, it can look very different if you have to put that building on an individual policy, or, if they have a loss limit or a higher deductible, or had a bad loss. It's really helpful if you can request loss runs and then copies of their policy early on in due diligence as opposed to later. Next, we'll get into our second to last tip here, and this is back to builder's risk. The builder's risk carriers are very wary of large construction contracts. The larger your contract, the fewer the carriers who will be willing to entertain quoting builder's risk for the project, and they're super small amount of carriers who will quote a project that has greater than a $25 to $30 million construction contract. Once you get up to that size, we're typically having to put a stacked policy, a builder's risk policy in effect, where you've got different. You have to have multiple carriers, each taking a certain section of the construction value, because one carrier is likely not gonna write a project that large. So anything under 25 to 30 million, you can possibly find one carrier to write the whole builder's risk policy. But once you get above that $30 million range, usually you're having to go to a stacked carrier program.
And that's not, the retail person does not see that. You have a policy that's inclusive and it's going to cover the whole value of the project. But what it does is it limits from an insurance person, it limits the amount of people that can access a marketplace. And so you just have to be cognizant. All right, if it's over $25 million, I know that I'm probably going to have 4 different carriers or 3 different carriers participate in that risk. And so it just limits the overall carrier pool out there. So you're probably going to have, we're not having any problem getting those quotes. It's just the amount of competition gets smaller once you get above those thresholds. And so it doesn't necessarily impact you guys on the other side of it. It just impacts the way we have to market a project. And there are some that specifically, draw the line at 35 million, and then that's there. So there's a little bit of a tolerance there between 25 and 35 million before specific carriers say, hey, that's too big. And then you go into a layered program. And if it's between the 25 and say $35 million range, you can have both the standard market carriers like a Liberty Mutual or a Travelers even providing a quote for builder's risk. And then you can have the surplus lines marketplace where we do a layered program or shared limit program providing quotes. So there's a little nuance in there, but obviously the bigger the project, what they're scared of, and to be frankly honest, it happens a lot more than you could even imagine. They're scared. Most of these deals are frame. They're scared of these large losses on frame hab. Once they get that construction, when they're framed up to 40 and 50%, we're still seeing surprisingly some large fire losses. And when you lose one of those projects of that size, that puts a kind of a shockwave through the industry, in the builder's risk industry. And so they're very cognizant of frame risk when they get above 25 million.
All right, well, if no questions here, we'll move into our last tip here, which is, there are certain building characteristics which are instant quote killers for underwriters, as in they will not quote if any of these features are included in the building. And these are, aluminum wiring, Federal Pacific stab lock circuit breakers, Zinsco Sylvania Challenger circuit breakers, emergency pull cords, armed security guards, and historic registry status. A lot of carriers, or a lot of underwriters, if they see any one of these features or characteristics at a building, they'll say, sorry, I can't quote this. My guidelines say I can't quote it. So if the fewer of these building characteristics, the better, and the more insurance companies you're going to have at the table willing to quote insurance for your building.
Most of those stab lock breaker issues are coming from acquisition rehab deals where we're not replacing those, or if you're just purchasing a property that was pre-1990 construction, could have those Zinsco breakers.
This is actually our last slide. So we've got, if anybody wants to stick around for questions, I can answer questions all afternoon. So please fire away. And if not, if you got to go, or I'll email the slides out to everyone who attended. So thank everybody for your time. If there aren't any questions, thank you. And I'll be here for any questions though. If anybody has one, please unmute yourself or put it in the chat. Here we go.
Yeah,
Great
thanks everybody
presentation.
for participating.
Thank you, guys.
Yeah. All right. Well, maybe it looks like someone might be typing here. Let's see. All right. Well, I think unless anybody has any questions here, I'm going to log off. Thank you everybody for your time. I don't think we have any questions. So thank you. And if you do have a question, please email or call us anytime. Here's our contact info.